Okay, let's unpack this. We've been watching Rockwell Automation, and, it's been a time where global capital spending felt, well, kind of stuck.
Hmm. Definitely uncertain.
Yet, these end-of-year results for fiscal 2025, they're not just about getting by. They're actually showing some really powerful execution.
Yeah, especially on cost control and margin expansion. It's pretty striking.
They found a way to boost profitability, even with big factory projects still, on the cautious side.
That's really the core insight here, I think. Our mission for this deep dive is to, well, get past the surface level numbers
Right.
and really pull out the key strategic moves from their Q4 and full year results, and importantly, what they're signaling for fiscal 26.
Like a great case study, really. How a big industrial automation company pivots when the market's volatile.
Exactly.
So the big question for you listening in is this. How did Rockwell, a company so linked to industrial capex, actually manage to get back to growing revenue and push margins up so much?
Yeah, how'd they pull that off?
Clearly, it wasn't just about waiting for the economy to turn around. It had a plan. Okay, let's start with the financials. Fiscal 2025. They finished the year pretty strong, didn't they? Especially Q4.
Oh yeah, Q4 was solid. Reported sales up 14% year over year.
And organic.
Organic was up 13%. So, real core growth there.
Yeah.
Suggests good momentum going into FY26.
And that operational strength, it really hit the bottom line. Adjusted EPS.
Came in at $3.34 for the quarter. That's 32% higher than the year before. Huge jump.
Wow. So double-digit growth in both sales and earnings for the quarter.
Right. Which is impressive given, all the macro worries throughout the year.
So looking at the full year, fiscal 2025, it looks like, well, stabilization, maybe slight growth overall.
Yeah, reported and organic sales growth landed right at 1% for the full 12 months.
Okay, so not exactly explosive, but they definitely recovered from some earlier weakness.
Exactly. And importantly, the full-year adjusted EPS hit $10.53. That's up 7% year over year. Pretty respectable.
But the how is the really interesting part.
That's where the story is. They went big on internal efficiency. Productivity.
They set a target, right, for structural savings.
Yeah, a pretty ambitious one, too. $250 million in savings they were aiming for. And these are meant to be, permanent cost reductions.
Not just one-offs.
Right. And they didn't just meet it.
They smashed it. Over $325 million achieved.
Yeah, $325 million plus, which is, that's a significant beat.
It really is.
Yeah.
But it does make you wonder, is that $325 million truly sustainable? Or was it sort of a one-time cleanup during a slow patch?
That's the key question, isn't it? Management insists these are structural. Streamlining, reducing complexity, optimizing the supply chain for good.
If they're right, that sets a much higher base for profitability going forward.
Exactly. And the best evidence, I think, is the cash flow. Free cash flow conversion was incredible, 114% for the year.
Way above the 100% target.
Way above.
So just for you listening, that 114% means for every dollar of net income, they actually generated $1.14 in cash.
Which is just fantastic.
It really signals tight operational control, great working capital management, maybe the best sign of real sustainable operational health.
Couldn't agree more.
Okay, let's shift gears. Section 2. This is where things get structurally different. Big strategic moves and some complex accounting changes in Q4.
Yeah, some major shifts. Let's start with the big one, the Sensia joint venture.
With SLB, right?
Yeah. They decided to go for an orderly dissolution. That's the official term.
And the reason?
Simple enough. It did not meet our long-term expectations. So Rockwell takes back 100% ownership of the process automation bits they put in originally.
Dissolving a major JV with a partner like SLB, that's a big deal. Sounds like they're admitting it didn't quite work as planned.
Pretty much. They're choosing simplification over, complexity that wasn't paying off.
What went wrong? Any context on why it didn't meet expectations?
Well, it seems like a combination of things. Bad timing for one, launching right before COVID hit.
Ouch. Especially for energy markets.
Exactly, which was a big focus. Plus, the scope was really broad, maybe too broad. Added cost, complexity.
And the returns just weren't there to justify it all.
Apparently not. Just wasn't worth the headache of the JV structure.
Okay, so financially, what's the impact of unwinding this?
It's interesting. Think of it like this. They cut a project that was taking up management time but wasn't really adding much profit.
Right.
So annually, revenue drops by about $250 million because the JV revenue comes off their books.
Okay, a $250 million hit to the top line.
But, and this is key, Almost zero impact on operating earnings.
Because the JV wasn't making much money anyway.
Exactly. It was barely profitable. So this move, the simplification, actually gives them about a 50 basis point boost to their overall margin going forward.
Ah, okay. Trading lower quality revenue for a higher overall margin profile.
Precisely. Quality over quantity. Makes sense.
Okay, that clarifies the Sensia piece. Now the accounting adjustments. These are important for you, the listener, to understand how their future margins will look.
Definitely. These Q4 changes really alter the look of the income statement, even if the total profit doesn't change. First up, how they classify engineering and development, or E&D, costs.
Okay, R&D type costs.
Yeah, R&D and sustaining engineering. Historically, about 8% of total costs lumped into cost of sales.
So mixed in with the cost of actually making the products.
Right. But now, they're moving that 8% down to operating expenses.
Which is where most of their tech peers report it.
Exactly. It aligns them better with industry standards. The immediate effect. Reported gross margin jumps up.
By how much?
By about 8 percentage points.
Wow, 8 points. But again, zero actual impact on the bottom line profit, right?
Correct. Just a reclassification,
Wow.
purely about reporting clarity and making comparisons easier for investors.
Shows they want the market to understand them clearly. It's not
Yeah.
just about operations, but also communication.
Absolutely. And the second adjustment, it's to how they define adjusted EPS.
Okay, what's changing there?
They're now excluding certain legacy charges, specifically old asbestos and environmental liabilities.
Stuff unrelated to today's business.
That's the argument. Costs tied to the past, not current operations. This meant taking a pretty big one-time pre-tax charge in Q4, about $136 million, related to updating the accounting for these old liabilities.
So another move to clean things up, focus attention on the core business performance today.
Get clean house, focus forward.
All right, so these changes show a company getting leaner, simpler, focus on quality margins. Now let's see where that focus paid off. This is where it gets really interesting. The growth drivers in Q4.
You can definitely see the impact of prioritizing digital and connected solutions. Segment-wise, software and control was phenomenal.
How phenomenal.
Organic growth up 30% year over year.
30%, wow.
Yeah, mostly driven by their core Logix platform. That's like the central nervous system for automation.
That kind of growth in a tough industrial climate is pretty amazing. What about intelligent devices, hardware, robots?
Also strong. Organic growth of 14% year over year. That was led by power control, including the CUBIC business they acquired.
And the robots.
Yeah.
The AMRs.
Yeah, the OTT autonomous mobile robot business. Double-digit growth for the full year 2025. And they actually expect it to turn profitable in fiscal 26.
Okay, so that investment in next-gen mobility is starting to pay off. Scale and profit coming through.
Looks like it. Patience rewarded there.
But there was one area that was down, right? Lifecycle services.
Yeah, down 4% organically in Q4.
Why the dip there? What does that tell us?
I think it says a lot about customer caution. Lifecycle services covers things like consulting, optimization projects, kind of discretionary spending.
Stuff you can put off if you're nervous.
Exactly. When customers get worried about the economy, those are often the first budgets to get delayed or cut, even if they still need the core automation gear.
So it suggests that while core automation needs are still there, big, pricey, long-term service projects are still maybe on hold a bit.
That seems to be the read, yeah.
So let's talk industry winners. Where do they see real strength?
E-commerce and warehouse automation. Just a spectacular Q4. Grew over 70% year over year.
70%, that's huge.
It really shows the pressure companies are under to optimize logistics, fulfillment. That 70% involves selling everything. The OTTO robots, the Logix controls for conveyors, the software, integrated solutions.
Shows where spending is still strong, immediate productivity gains.
Absolutely.
What about traditional industries? Auto.
Automotive did well, low double-digit growth. Seems like the industry's settling into that mix, EV, hybrid, traditional engines. They need flexible automation for all of it.
Any other surprises?
Data centers were surprisingly strong. It's still relatively small for Rockwell, but showing strong double-digit growth.
Driven by?
Demand for advanced cooling, they had a nice win with alternative heat in Europe and just the need for faster deployment. AI is fueling a lot of that.
And the software wins really back up this digital story.
For sure. Like Stanley Electric, the big Japanese auto supplier, deploying Rockwell's cloud-native Plex platform, 25 sites globally.
That's not just selling a piece of hardware, that's selling an entire operational system in the cloud.
That's exactly. Or GSK in life sciences. Picked Rockwell's Verve platform for managing asset vulnerabilities. 33 sites, 5-year deal.
Sticky, recurring revenue. cloud-based. Ties right into their goal of growing ARR.
Which grew 8% for the year, by the way, so that strategy is working.
And one last point on the core HealthLogix unit volumes. That's important.
Very important milestone. They finally got back to pre-COVID levels in the second half of FY25.
And the outlook.
Expected to actually surpass those levels in FY26. Suggests they're gaining share, expanding the market, helped by new tech like the new Logix L9 processor.
So the core brain of their systems is fully recovered and pushing forward. Good sign.
Very good sign.
Okay, so that leads us nicely into the path ahead. Fiscal 2026 outlook. It feels like they're balancing their own operational confidence with maybe a still cautious view of the wider economy.
I think that's a good way to put it. The guidance calls for reported sales growth between 3% and 7%.
And organic.
Organic is expected between 2% and 6%.
And the bottom line, adjusted EPS.
Midpoint projected at $11.70. That's a healthy step up from 25. The full range is $11.20 to $12.20.
They seem to be baking in some conservatism, maybe not counting on a huge rebound in big CapEx projects just yet.
Yeah, the pattern they expect is typical seasonality, so a sequential dip in sales in Q1, then gradual improvement through the year.
Like they're not waiting for a macro tailwind. They're planning to make their own growth.
Pretty much, and the margin story reflects that confidence. They expect segment margin to expand by over 100 basis points.
Okay, well, let's pause there. 100 basis points, that's a full percentage point improvement in operating margin.
Right.
Even with that somewhat cautious revenue outlook, shows real belief in their cost model.
Huge belief. And get this, the full year incremental margin is expected to be over 40%.
40%. That's way above their usual long-term target of 35%.
Way above. What that means is for every extra dollar of revenue they get in FY26, they expect 40 cents to drop straight to profit.
That's efficiency. That's the payoff from those $325 million in structural savings in 25.
That's exactly what they're saying. It's productivity and also maybe more normalized compensation costs compared to the high inflation period.
What about pricing?
They see price contributing about 2 points to growth, about 1% from underlying price increases, and 1% from passing through tariffs.
And the tariff strategy itself?
Still EPS neutral, the price increases just cover the tariff costs. No net impact on earnings from that.
Geographically, where do they see the strength?
North America. Expected to be the strongest region in FY26. You know, reshoring trends, productivity focus.
And they're putting money behind that confidence.
Yep. Announced a $2 billion investment plan over the next 5 years, focused on modernizing their own facilities, growing talent, boosting digital capabilities.
And mostly benefiting the U.S.
Primarily, yeah. A clear long-term bet on their home market.
So what does this all mean? Let's wrap it up. The core story, it seems to me, is Rockwell just executed brilliantly on the things they could control.
Absolutely nailed it.
Focused on that structural profitability, delivered amazing cash flow, blew past the savings targets.
Mm-hmm.
And that strength really kind of insulated them from the ongoing uncertainty in global CapEx, allowed them to grow profits strongly, even when the overall market felt sluggish.
They definitely chose quality over quantity this past year, getting rid of a complex, low-margin thing like the Sensia JV,
Right.
and doubling down on high-growth, high-margin areas like cloud software, e-commerce automation. It significantly improved the health, the quality of their earnings.
So they come out of this looking leaner, more digital, more focused.
Yeah, ready for whatever comes next, macro-wise.
Which leads us to a final provocative thought for you, the listener. Think about that Sensia decision. Publicly admitting a complex JV wasn't worth the effort. Contrast that with the clear success of simpler digital offerings like Plex software or the OTTO robot.
It really feels like a turning point, doesn't it?
It does. So if these simplified structures and high-margin digital solutions are so clearly driving profit for Rockwell, how quickly will the rest of the big industrial players follow suit?
Yeah, how fast will they move to aggressively streamline their own operations? Maybe ditch complex legacy structures or partnerships that just aren't pulling their weight anymore.
Are we seeing the beginning of the end for complexity as a default strategy in this sector? Something to think about.